Hi, good morning, everyone, and welcome to the Go Fly Master Lecture today. To get us kicked off, I'll pass it over to Gwen Leiter, CEO and founder of the Go Fly Prize. Gwen?
Hello, everyone, and greetings from California. We are so pleased that you are all joining us today for our very special Master Lecture. As you all know, Go Fly's grand sponsor is Boeing. And in addition to Boeing, we are joined by over 20 different aerospace and STEM organizations throughout the world, including several in-kind sponsors, and you'll hear more about that in the coming weeks as we bring on even more companies to help you grow and build and with your products and services and software. Today's Master Lecture features Jim Murray from PJT Partners, as well as Will Porteous, and we are thrilled to have them both here.
Thank you, Gwen. This is Will Porteous. I'm a general partner at RRE Ventures, and I have the privilege of serving as the chair of the finance track for the Go Fly program. I'm here with Jim Murray. Jim is a founder and partner at PJT Partners. He founded the firm along with his colleagues after a distinguished long career at Morgan Stanley. Jim has advised on more than 100 significant M&A transactions. He's raised more than $150 billion in capital for clients. But important to this conversation, he is also a company founder. and he, like many of you, has lived the journey of growing a team, building an organization, and thinking about the long-term outcome, as well as what he's done for his clients. Today, we're going to have a little bit of a fireside chat, if you will, though without the fire, and talk a little bit about outcomes. The title of our talk today is Sticking the Landing, and Jim is going to provide most of the perspective today. I'm going to be asking him some questions. But the topic is really about outcomes. It's about how to plan for and execute the ultimate exit of your company. And I think as you'll hear over the next hour, there are a lot of very practical, straightforward things that you can do to ensure that ultimately, when the time comes to exit the company, that you have a lot of options. Great companies aren't just suddenly bought by a lightning strike out of the sky. They're great teams that run them have done a tremendous amount of preparation and laying of the groundwork for those great outcomes. With that, let me turn it over to Jim and let him kick off and tell you about PJT.
Thanks, Will and Gwen, and welcome to a conversation which I hope will leave some time at the end for Q&A. But my objective here is to walk you through both a few principles about how to think about exiting your startup, but also some rules to live by as your company continues to grow. I think that the theme that we're going to come back to, we reached very early in the presentation, is that good exits are built one step at a time, really from very early on in your business's life cycle. And so it's important every step along the way to have some rules to live by, some guiding principles, and hopefully we'll take a stab at what some of those could be during our conversation. As Will said, just a quick intro to PJT. PJT is a next generation investment bank. Really, PJT started in early 2014, where Paul Taubman, our chairman and CEO, decided that he wanted to reinvent the business model around investment banking and in some ways get back to basics, to focus on clients and to strip away some of the bureaucracy and some of the issues that had come with the evolution of the large bulge bracket investment bank over time. Since the business was founded in early 2014 with 5 partners, we've gone through a major merger with the investment bank owned by the Blackstone Group. We've done a spinoff from Blackstone, a public listing, and we've continued to grow the business at double digits year on year throughout that entire period. As of today, PJT has about 500 employees, just over 60 partners, and we have a market cap of about $2 billion. We have a global presence. We're focused on providing best-in-class advice really across three different areas. One, we provide M&A advice, which we're going to talk most about today. We provide advice around bankruptcies and restructurings, which is not where we want to take this conversation around startups. And we provide advice to private equity funds, venture capital funds, hedge funds, real estate funds, really working with GPs and folks like Will to think about how they raise money, how they structure their business, et cetera. Shameless Advertisement, just to give you a context of the types of folks that we work with. These are major transactions that we've been involved in the last 12 to 24 months. We're currently representing Sky in their situation in the UK. We represented Yahoo on their sale to Verizon. We represented Lionsgate on their merger with Starz. So we're involved across the TMT landscape broadly. We do a lot of work in the industrial sector. We do a lot of work around healthcare, and we continue to grow the business. So we're one of very few investment banks that are out there that are actively building out our footprint, both geographically and industry-wise.
And Jim, I would say just from knowing you, particularly relevant to this audience, you guys have seen a lot in aerospace over not just your long career, but the careers of the partners who lead PJT. I think for the GoFly teams, understanding how value's been defined in past M&A events in the sector will be certainly really of interest, something we'll touch on.
Absolutely. We do spend a lot of time around both aeronautical aerospace and space aerospace. So really both parts of the sector. And in terms of startups that we've worked with that have done particularly well, we're close advisors to SoftBank and OneWeb, who are making big waves in the space-based communication sector. We've spent a lot of time with remote sensing companies like Spaceflight Industries, which is a company that Will knows well, and is focused on revolutionizing the supply chain related to space-based remote sensing capabilities. So we work with companies that are 10 people and valued at $30 million, all the way through companies that are tens of thousands of employees and valued in the hundreds of billions of dollars.
It's very relevant to our audience here.
So let's dive in and let's talk about really just some rules of the road in terms of managing your business towards an exit. And again, exits, the one thing that absolutely I know for sure is you can't control when an exit will happen, but you need to be prepared for an exit from very, very early on in the life cycle. Now, it helps in this context to really think about what does an exit mean? Most people tend to think about the glamorous kind of IPO where you're raising $1 billion and your stock pops 30% the first day, and you're on the front page of the Wall Street Journal. And that is certainly one path of an exit. But I like this graphic because I think it explains all the different potential outcomes of your business. In reality, the most likely outcome is that your business will continue to operate and it will continue to grow, and it will follow a path that leads eventually to some sort of steady state operating path. Exits can then be pursued as more of a matured company sale process. And we'll talk a little bit about what that looks like. But there are multiple types of assets that take different paths. So for example, there are companies that take the public markets exit, and we're going to talk about what types of businesses are appropriate for IPOs. Does it make sense? How far, how fast do you have to get in order to be there? There's also recapitalizations when you have early stage investors who actually want to take some money off the table. It's possible, short of an actual exit, for you to either put a little bit of debt on the company and actually send cash to the shareholders. These are called recapitalizations. The most extreme example of which is where you raise enough money to buy out your initial investors. That's called a management buyout. Or you could go down the path of actually facilitating a sale in a private market context of some of your investors' capital. And we call that a secondary sale. So we're going to talk about this graphic throughout the presentation, and we're going to look at different paths to different exits. There are some common elements in all of them, though. One of the common elements throughout all of this is that maybe the single most important rule of the road as a founder and as a CEO, and eventually as a minority owner of your company, because most companies that we work with eventually raise enough capital to fuel their growth that the CEO no longer controls the business outright. There are extremes where you use multiple classes of stock in order to maintain voting control. The reality is those are increasingly uncommon. And the truth of the matter is that most companies won't have enough leverage when they go to raise capital to use that type of a structure. Instead, you're selling a large portion of your business to an early stage investor. And so you become responsible not just as a fiduciary for helping to manage that capital, but also just as a partner and as someone who needs to really deeply understand what is it that your shareholders are trying to accomplish. Are your shareholders motivated by internal rate of return? Are they multiplying their actual cash and all they really care about is the dollars that they generate? Are they looking for a defined period exit because they have a particular fund duration and they need to return capital to their investors on a fixed time scale? Or are they more long-term motivated and frankly, they're investing perhaps for a family office or personal capital and they have a longer duration set of incentives?
If I could just sort of jump in here for a second, Jim, I think it's crucial for founders to really have thought through and to understand the motivation, the rate of return goal, and the time horizon when you take capital in any structure. I think that you need to run to ground expectations, because the moment you take investors' money, you sign up for a set of expectations, their expectations for what the ultimate outcome may be on the business. And it's not so much the point of no return, but it is the point at which you lose a lot of optionality and you have to be 100% focused to growing value along the lines of the plan that you committed to investors when you raised money. And I know that, Jim, in your long career, you've seen CEOs who've managed an investor base really well and perhaps some who haven't managed them quite as well. Any observations on what goes into kind of managing your investor base?
I think frequent communication is the first part, because expectations are dynamic. And as market conditions change, as the performance of their portfolio changes, their motivations tend to shift as well. So you need to speak frequently and with real clarity and with real candor to your investors. There's no worse outcome than a misalignment in expectations or a misalignment in terms of the facts on the ground. And generally, making presumptions about your investors' incentives or about their desires is a bad way to go. Candor and your comfort in having a candid conversation with your investors is a huge screening factor up front in terms of actually determining who the right investors are for your business. If you don't feel right from the first conversation that you have with a potential investor that this is somebody that you can have an honest, open, and ongoing dynamic conversation with over time, they're probably not the right investor for you. The second principle that I want to enforce is that while many founders are the most valuable player on their team, that no successful exit I've ever been involved in has not relied on a deep bench of talent as a management team. Now, this becomes a little self-fulfilling because I think Will tell you that he invests in teams, and I hear that from investors all the time, that they won't invest in a company where they don't perceive real bench depth. Because the reality is that the job of CEO is only one part of what makes an organization successful. And that you have to work as a team both to impress investors up front to raise the capital to build your business, but then when it comes to an exit, key person risk, founder risk, is a very, very important consideration that a buyer will look at. So if it's a financial sponsor that's later in the life cycle and buying more mature companies, or whether it's a strategic buyer, perhaps a large aerospace company or a prime contractor even that's looking to add capabilities, one of the key questions they're going to ask is, do those capabilities evaporate if the CEO and founder decides to walk out the door? We're going to get back to a little bit about how they take steps to prevent that from happening. But as a fundamental principle, having a robust team around you, taking the 27 Yankees approach to where we're going here, is the right way to go, and it's going to facilitate your exit down the road. Now, there are situations where that doesn't happen. There are situations where the organization is overly reliant on one individual at the end of the day. What I'm suggesting is that's going to have a material impact on your ability to exit, on the valuation at which you exit, and on the restrictions placed on you as an individual and as a founder at the time of the exit. And so it's something to keep in mind as you build your team from the beginning. Who am I going to go out with when it comes time to sell the business? And how will we be perceived as a team? Are we the standout rock star model, or are we the team that plays really well, 4 quarters a game and actually gets the job done? The next really important part of your business and really important part about planning for an exit and for raising capital in the beginning is, and this will come as a challenge to some because this is where we're going to get into a little bit of finance, which is never the most fun for people who are focused on innovation and operations. You have to have a model that as the CEO, you really understand to its core. And as a team, and that team includes the operating team, the senior management team, and the board of directors, you have to have a set of assumptions about how your business operates that you all share. It's a common understanding of the economics and business proposition that you have. When I say model, one of two things usually happens, and sometimes both. People's eyes glaze over, but then also people imagine a very large Microsoft Excel spreadsheet. When I'm talking about the model, I am talking about something bigger than that. I am talking about, if you think about it, the laws of physics of your business. So if you want to think about Newton's laws as the foundation for everything that we really do around aerospace, the actual opportunity around the model is a set of relationships between your inputs to the business, what you're taking as raw material, and the outputs. And along the way, how much does it cost to transform inputs into outputs, and what kind of profit is left over? And that is at its root cause your model. And translating those relationships into a series of formulas and cells and outputs in your model is a specialty task. It's not something that you can wing. It's not something that you can backfill once you've started an interesting conversation with a potential buyer. And importantly, it's something that really should be immutable. It should not change between when you begin raising money and when you finish raising money. It should not change between when you begin a sale process and when you end a sale process. Quarterly results, big customer wins, changes in supplier relationships, they can change values within your model, but they shouldn't change the model as a whole.
So Jim, this is a really interesting way to look at the topic of the maturity of the business. If I'm an aerospace entrepreneur and I built a product, but I've only just begun to sell it, what do I have then? Do I have to go all the way in building a business and proving every aspect of the model for someone to value me highly in an exit?
So no, I mean, the strict answer to your question is no. So innovation itself can be enough of a value creation event that having developed and patented a particular technology, you can go out and you can monetize that. But a couple of important points. If you don't understand how valuable that innovation is, and if you can't put a price tag on that, you have no context for a conversation with a potential buyer. You don't know whether you are giving away the company too cheap or whether your valuation expectations are completely out of reach. Fundamentally, if somebody buys a product you've created and that you've innovated, their willingness to pay is going to be defined by a couple of things. One, how much would it cost them to try to recreate it on their own, if such a thing is possible given intellectual property constraints. Two, how much money can they make selling the product, right?
Right.
And then three, when you intersect those two things, what would I be willing to pay you to buy your product or your innovation or your IP or your patent portfolio, and then turn that into a full production scale product? So again, the answer to your specific question is yes, you can monetize without building out an entire business. That being said, I think almost as a rule, if you build a successful business out of the product, you will receive much greater compensation for your innovation than if you just tried to sell it when it was still at the conceptual or even advanced prototype stage.
Yep.
And I think that those are my perceptions. There's always an example that disproves the rule, but I think that those are general rules to live by. So again, the last point about the model is the model becomes a tool you use to communicate the truth of the profitability of your innovation in your business to your audiences. And those audiences are going to change over time. Again, there'll be investors, early stage and later stage. There'll be lenders when it comes time to borrow money in order to fund growth. And they're going to be buyers. You cannot have three separate models. You could have different outputs from the models. You can run different scenarios. But early on, you as a founder need to understand those fundamental economic principles of your business. And if this isn't your strong suit, this goes back to my point on the bench depth. Someone within your organization needs to own this as a core function of your startup. And you need to have a relationship with those individuals that are responsible that is based on trust, transparency, and the ability to set ego aside and really probe what those numbers look like so that when the time comes to share them with your board or share them with investors or a potential buyer, everybody is on the same page. And there's no uncertainty around it and numbers aren't moving all over the place. Another way to think about an exit is to begin to think about what are the milestones in the life cycle of our business that we're actually going to use to cue either raising more capital to fund growth or potentially beginning to think about hitting the button and exiting the business. When you think about a startup, there are milestones that I look for when someone comes to me and says, I have a business I'm thinking about potentially selling. And value increases across these different milestones. But the truth of it is that there's no hard and fast rule on where you need to be in order to exit. So there are companies that will come along in the development phase. They have an alpha or beta release of their product. You know, in a physical product context, you might talk about that as a prototype or an advanced prototype. But they're clearly not yet out in commercial operations. As Will mentioned, it is possible to sell a business at that point. It's a different kind of sale, but that is certainly possible.
Jim, let me just ask, is it too soon to start talking to partners, particularly industry partners who might ultimately be acquirers of the company when you haven't launched the product yet? And should founders and entrepreneurs be scared of giving away their secrets in that context?
So we're going to come back to the topic of communication. And in general, the answer to your question is no, you shouldn't be scared about talking to people. I have some hard and fast rules that I tell founders, and one of which we'll come back to is never talk about your model until you're in a much more advanced discussion. That's a little bit the secret sauce. I think that the flip side of that is you need to take steps to protect yourself if you're going to have any conversations around intellectual property. And we're going to talk about lawyers and the role of legal counsel. So in a context where you are properly protected from a legal point of view, and where you're confining your discussion really more to vision or to major publicly announced milestones, I have no problem with an early conversation before product launch. I don't like to get into conversations around your financials or your economic model. I don't like to get into a deep dive around the IP. I don't think you're doing yourself any favors in either of those. So the other milestones that we look for are product launch, actual building of a backlog of customers, generating revenue and actual generating financial results, and last, generating profit. The point I want to drive home here is that there is no red line that when you cross over between one of these 5 categories, you're instantly available for sale. Sales happen at every step along this process. What you really have to think about, though, is that value increases across this entire process. So back to what are your investor milestones and what are your investor motivations? If your investors are looking to exit and you're through, the subscriber, portion of your business, or if you're talking about a product-based business, you actually have paying customers, that can be adequate to sale. But you need to understand the trade-off between valuation and the trade-off between timing of exit as a result. But these are kind of the milestones, and a good founder has in her head or his head at all times these 5 kind of milestones, and they can articulate, here's where we're going to get to product launch, Here's where we're going to get to a critical mass of subscribers or customers. Here's where we're actually bringing revenue in, which fundamentally changes our financials. And here's where we're going to be profitable. These dates can move around in your head, but I would think that every good CEO, and frankly, every good CFO and COO, the whole senior management team, ought to be singing from the same hymn book in terms of when these events are going to happen. So communications, Will brought this up. What are the types of communications that are acceptable in terms of preparing the market for an exit? I think that early on, it's fine to be out talking about your business. I think that there is a concept that really has originated more in the technology world about stealth companies. That's really appropriate, particularly in areas where there are low barriers to entry and where your concept is really your innovation. If your concept, use an example like an Uber, is your innovation, and it's harder to put in place intellectual property protections or legal protections that actually prevent someone else from copying your concept and rushing to market, then stealth is actually the way to go. But in aerospace, my experience has been that talking about your business is something that you need to do from a fairly early stage.
Let me pick up on that though,
Sure.
Jim, because I think there's every emerging company wants to appear bigger and stronger than it is. Every emerging company wants to appear that it's farther along and bringing a capability to market than perhaps is really the case, if only as a way to shut out competition and to kind of distinguish yourself in the marketplace. When our GoFly entrepreneurs are giving interviews or conferences or even talking to investors, how far can they go? And how far is too far in terms of what you say about your plans, your progress, and how far along you really are?
So it depends on your audience is the unfortunately vague answer, but let me try to drill down on that a little bit. If I'm doing an interview with the press, there are certain things you never talk about. You never talk about financial metrics of any kind. Again, if we talk about the milestones on the previous page, you are going to be incredibly vague about potential milestones. Leave yourself wiggle room. The problem in a persistent data environment that we all live in with the internet is that anything you say about your business will be Googleable, and it will come up in an investor meeting that you have 6 to 12 months from now. And if you gave an interview to your hometown newspaper because they're doing a profile on innovators, and you have an exciting story and it's a high growth business, and you say, we're going to ship product in the first quarter of 2018. And now we're recording this in April of 2018, and you haven't shipped product. And you're meeting with an investor in October of 2018, and you still haven't shipped product.
Yes.
The investor's first question is going to be, what went wrong?
Yeah.
When in reality, you might have been a little bit aggressive when you used that first quarter target. So you should talk about your vision for changing the business, but I'd be incredibly careful about talking about milestones. Certainly, I would never talk about financials in a public forum. I would be very careful about committing yourself to a timeline in general to hitting the milestones we talked about on the previous page. But the one point that I'd make on this page is that as a CEO, you're almost always going to have to do all of the 6 items on this page. You're going to have to spend time with interviews. You're going to have to be invited to conferences, and you'll have to know how to handle those. You may be in a business which requires advertising. Not all businesses, particularly around aerospace, that's relevant, but it's a basic forum for communication. You will be meeting with investors. You will have conversations in a sales context. And the point that I make is that being a disciplined communicator who shares exactly as much as you need to share, but nothing more, is going to pay dividends in spades. There is no quicker way to get into trouble than talking about money. And the reality is that when you go do a big financial raise, you go raise $50 million to help turn your product from the prototype stage into full production stage, you want to shout that from the rooftops. It is a natural human instinct. You're going to have a celebration internally. You're going to be excited. Your board is going to be high-fiving you, and you're going to feel great. And your instinct is going to be to shout that from the rooftops. My advice to you is don't. my advice to you is to follow the maxim, act like you've been there before. Really take on board the fact that anything that you say about your finances, anything you say about the valuation where you raised money, this can only hurt you in the long run. You might think that it creates this perception that you're the biggest, baddest guy on the block, but in reality, there's a lot of scenarios where you're telegraphing something to a particular audience of investors or customers that through their frame, they either think you're overvalued, or they think you've still got a lot to prove, or they're frustrated that you were able to raise money when they weren't. The point is, unintended consequences result when people talk about money in market. So we're rolling forward the tape now. You've got a great management team. You've built your product. You've raised some capital. You're being a disciplined communicator. And eventually your board, whose objectives and the motivations you totally understand, come to you and say, it's time to start thinking about going public. As a founder, this is one of the most consequential decisions that you can ever make. And it really comes down to, is the cost of being a public company really worth the distraction, or is it really worth the benefits you can perceive from it? So if we really think about the cost of being public, you see all the glamour when you see a company go public, but have you really thought about the distraction? As a CEO, if you're spending every waking hour building your product and getting it to market and dealing with customers and communicating with your board, do you want the additional difficulty of quarterly earnings? Do you understand your sales cycle enough to know that you can reliably hit market expectations in terms of where you're going to be able to ship product, where you're going to be able to introduce the next generation of a product, how your sales from a financial perspective are going to trend, when profitability is really going to be accomplished? Because oftentimes, companies that go public do so too early, or they go public with a poor understanding of what the market is going to expect from them in terms of performance and delivery. And that is a one-way path to a drop in share price and really feeling uncomfortable about what you've been able to accomplish in terms of your public market audience. And more companies than not, when you talk to them a year after going public, are unhappy with where they actually stand. And so I want to caution people up front that going public isn't a panacea. Yes, it brings a lower cost of capital. Yes, it could mark you to market at a terrific valuation. It could provide ongoing access to the capital market, providing that you continue to meet market expectations. My point here, and I'm going to come back to this a little bit later, is this is a decision that requires a deep amount of soul searching, really informed conversation with your board, and conversations with outside advisors who have been there before and are going to speak honestly to you about the costs and benefits of going public. We're going to talk a little bit about engaging with financial advisors and some rules to live by. But again, here, trust is so important, that you're having a conversation with someone who's looking out for your best interests over the long term and not really thinking about instead whether or not they can make a fee off taking you public in the short run.
Jim, just before we leave this slide, I just want to kind of ground the concept of going public properly for our audience. Is it fair to say you really have to prove your model and scaled your business to be a public company? Because earlier we talked a lot about kind of there's the product and then there's everything around the model, and it strikes me that to be eligible for the lower cost of capital and the capital market access and the liquidity that goes with having a public stock, you've fundamentally got to be in business. Is that a fair statement?
To be a happy public company, yes.
Right.
It is possible to go public with only partial solutions to the boxes you just kind of laid out, not every one of them being checked. And we've seen some of those stories in the past where you have high-flying public companies that don't have a great grasp on their product path. They don't have all the capital that they need in order to be successful. Or going back to our conversation about the model, they got the model wrong. And the inflection point between not being profitable and being profitable, or to be more specific, not being self-funding and being self-funding, they got that fundamentally wrong. They got the scale benefits wrong. They didn't understand the competitive environment. They didn't understand the pricing and how that was going to change. I've seen companies fail on all of those tests that at the end of the day, they went public. They're in a weaker spot now than they were before. Because let's remember one last point before we shift gears away from going public. Going public is the one thing you control in terms of timing. It is your decision. When you decide that you want to go public, you put that path into motion. So you can't blame anybody else that the timing wasn't yours. If you decide to go public, you are going to be revealing your economics to everyone. You are going to be talking in detail about your product strategy. You are going to be telegraphing to your competitors what your competitive strategy is, talking about your distribution plans, talking about your partnerships. It is the ultimate kind of opening of the doors for people to come in and take a look at where you've been living and how you've been building your business for the last few years. That is something you cannot undo. And it is often the case that a company that goes public initially takes the success of the offering and feels great about it, but when they go to sell the business, it's so open kimono that they actually get less value than they could have had they remained private. Because when you talk about a private sale, what you're trying to avoid is an exit on other people's terms. Being forced into an exit because I went public too soon, my stock price is down, the investors who bought in the offering are really unhappy with me, my board is on my back because I haven't been able to get the stock price up, when actually, when you just look at operating metrics, I'm doing everything that I said I was. As a public company, you can be forced to sell your business, particularly if you're no longer the majority shareholder. This is something that founders really don't understand, is giving up majority control of your business in a private investment context is one thing. Going public is completely a different story. When you have institutional public shareholders or retail public shareholders, your board really is a fiduciary, and it is going to have to look at decisions the way that they have to in a legal context. So again, the big thing to avoid is giving up control. Let's assume you didn't go public. Let's assume that you stayed private. You said, you know, Jim and Will told me to be careful not to be chased off the stage by a bear. I want to go forward now and I want to sell my private business. The first thing to understand is this is going to be a rigorous data-driven process. You are not just going to get an offer to sell your business and somebody's going to stroke a multi-million-dollar check to buy the company and not do a lot of work to follow it up. You're going to have to go through an exhaustive process of what you've all probably heard the term due diligence. Due diligence is used as a verb, which is frustrating. What is really going on is that the buyer has to be diligent. They have to exercise all due diligence in evaluating a target because they are stewards of their own company's capital. And when you do that, I've tried to lay out here a few different targets that these are the normal buckets within which you need to be prepared to have a conversation. So if you're thinking about selling your business and you don't have a good handle on litigation you might be involved in, if you don't have at hand all the key contracts of the business, all thoroughly vetted by your lawyers, all cleaned up, absolutely ready to be shared with the other side, if you can't talk about your sales pipeline in really granular fashion, you're not ready to engage with the buyer of your business. The only thing worse than not being prepared to interact with the buyer is to actually get the buyer excited about buying your business and then tell them, hold on, I've got to go prepare for a due diligence process. I think Will knows this more than anything, is you meet a founder, they get you very excited about your business, you see the vision, and then you realize that they're not organized and prepared in order to engage in this conversation.
Yeah, I think the good news about this is something that every founder listening to this call today can do something about. Think back to the early days of your company. Think about the stuff that isn't organized. Think about the contracts or the separation agreements that you want to make sure are signed, or the stock ledger. All of those things will be looked at by a prospective buyer. And it's a little bit of getting your house in order and being organized so that someone could very easily come in and unpack your business in every one of the categories that Jim has helpfully listed on this page for us. These are the questions that buyers will go deep on. And the better the answers that you have, probably the better the number, right?
Yeah, and this is, I believe, a fundamental role / responsibility in a job description of somebody, for example, in your business development team that you're building. It is critical that someone is looking at these categories from the very beginning and saying, there's a modular collation of data that is going on that, in between a big pitch and the next big pitch, when you have a few weeks during the summer and things are a little bit slower, and at a startup, nothing is ever slow, so there's never a great time to do this. This is the classic example of an ounce of prevention is worth a pound of cure. Don't have to take the whole team offline because, oh my God, we have a buyer coming in and we want to impress them. So we're going to stop running our business for 2 weeks and we're going to pull all this together. That's a way to lose focus, miss things in the marketplace, and probably hurt yourself more than you're helping yourself. Like Will said, start early, be organized from the beginning, and be able to deliver a conversation with an investor or with a buyer across all these categories when the time arises. And when that time arises, you've got to be able to deliver the pitch. This is, I believe, a fundamental responsibility of the founder of any business. You have to evolve the way that you talk about your business over time organically. But you constantly have to be revising and refining and testing themes that work and testing analogies or examples that work and being able to talk in a compelling, clear way about your business. And that doesn't just include your product. It includes your market. It includes who you think your competitors are. It includes your relevant highlights in terms of operational and financial performance. It includes your management team, why you work well together, why so-and-so is a key member of the team and what they bring to the party. These are all aspects that as the founder, you need to be able to deliver. And I will tell you that there are different contexts in which you're delivering it, and no one is good at all of them. This is something that you need to have mentors around. When I actually look at boards that do well by their founders and do well by their CEOs, making the CEO tell the story at a periodic basis is actually best practices. It doesn't have to be in a formal board meeting, but when you go to dinner with one of your board members who has real experience in working with early stage companies, are they challenging you to keep telling the story? Are they asking you how that story is evolving? This is something that you have to let go of all ego around. You have to surrender the notion that you're the one that tells the story the best. And you have to have a group of people that you trust, both inside and outside the business, that you can play that story off of. I can't tell you how many times I've sat down for an informal dinner with a client, just somebody that I've worked with over time, and they say, here's a new idea that I'm thinking about when we're telling the story, and they play that out. That is the kind of ongoing refinement of your story that you really have to have, because when the time comes and you're in a room with the CEO and the CFO and the head of M&A for a company that is there to buy your business, you get one chance to tell your story well. And if it's the first time you've told the story in a long time, or if you're trying out new material, in that conversation, you're taking a big risk. So it's much better, again, just like you've built the ability to comply with the due diligence process over time, your story is going to evolve organically, and your willingness and ability to tell that story has to evolve over time as well. Okay, so let's talk about advisors, and let's talk about how you can run that process. The first thing to understand is that you have two different types of advisors. There's a third if you include your auditors, but I'm going to leave that for another conversation. Any good sale of a business or IPO of a business is going to rely heavily on bankers and lawyers. And it's important to understand the role that they play in the situation. First of all, a banker really does 2 or 3 things in helping you sell the business. They help you find a buyer. They help you actually go through the process of facilitating the due diligence process, negotiating a sale contract, helping with your board in terms of getting through the necessary approvals. And then they actually help you consummate the transaction. So they're in the room in the final days as you pull together your press release. They're helping you position this with your investors who aren't on the board. They're helping you communicate around the deal. The fundamental cornerstones of a relationship with the bankers, though, are the same in all 3 or 4 of those categories. One, it's trust. You have to trust this individual, and that usually starts, if we talk about the groups of people that you communicate with over time, months and months, if not years, before you sell your business. If you're sitting with your board and you say the time has come to sell the business, and you don't have in your head a pretty good idea who you want to use as a financial advisor, you're starting too late.
So Jim, let's pick up on that, because I think probably a lot of our founders on the call are thinking to themselves, but it must be too early, right? We're still working on the product. You know, no one really knows who we are. We don't want to waste the time of a really important, influential banker like a Jim Murray or somebody like that. You know, surely we're not relevant for them yet. And you're kind of saying it's okay, and they should have those kind of conversations now.
So I believe that if you're an entrepreneurial aerospace company, you are going to be going to conferences, right? That's where you learn about what's going on in the industry. And at that industry conference are going to be bankers, okay? This goes back to a classic thing of how you manage communications. At an early stage, it is not too early to meet bankers with very specific kinds of conversations, mostly them talking to you, okay? The reality is the bankers will try to get you to talk to them, and it's okay to talk about your vision, and it's okay to talk about your product and where you're going with it, but you need to be guarded. You need to have a high-level conversation until the trust is there. And sometimes that trust is formalized with a non-disclosure agreement where you can then share incremental information. I would not be going out and talking wholesale to a dozen bankers. But you should be able to figure out at a conference by sitting and looking at panel discussions, or by reading about deals that were done, or by talking to your board members who likely have an idea of this thing, who are a couple of people that I could talk to. And then let them talk to you. Let them tell you what they're seeing in the industry. Let them tell you about how they see your story fitting into trends that are defining the industry. When you do that, you begin to build trust. You develop, hopefully, respect for that individual and their own capabilities. You learn a little bit about their personality, and you decide whether or not there's a good fit. Because if you're going to hire that individual to advise you, you're going to be in the trenches with them throughout the whole fight. And you're going to be foxhole buddies. And in that context, if you don't have trust, if they're not a practical communicator, right? So what's an example of that? A lot of people can talk about all the different hypothetical ways you're going to sell your business. But does this individual know the buyer, right? Do they say, this is the way that you should run a process? Call this person, that person, that person. They're the only 3 real buyers, and this is how we're going to engage with them. If you don't feel really in your gut that this individual has your best interests in mind, that this individual is capable of delivering in front of the board of directors, and that the board is going to listen to this person, are they senior enough? Are they experienced enough? Do they have a firm behind them that's going to deliver the manpower in order to actually do the analysis, to run a sale process? If you don't have all those things, I think that you're talking to the wrong person. And remember, once you hire this individual and you bring them in the tent, it's hard to get rid of them. They know so much about your business, they know so much about what you're doing, that they're the incumbent for a reason. So again, you have to hire a good banker.
Just a bit of a time check. We've got about 10 minutes.
So hire a better lawyer. This is the most important advice. As a banker, I will tell you that your lawyer really is the person that is going to get you through the sale power. Again, it's about trust. It's about a firm that can work more quickly than you are. You never want your lawyers to be the rate determining step in getting a deal done. It's about having technical capabilities around issues like tax, issues around CFIUS, if you're a sensitive part of the aerospace industry, issues around dealing with foreign potential investors or foreign potential buyers. And again, credibility in front of the board is essential. Then you really work with your advisors and you think about who are the right buyers. Are you selling the business to a competitor? Are you selling to a supplier? Are you selling to customers? Are you selling to someone who wants to get into the industry or the industry vertical that you're really in? Once you know who those potential strategic buyers are, the big question is, how much can they afford to pay? You're going to spend a lot of time talking to bankers about this because when you're selling to a strategic, they presumably can get more value out of your business than someone on the right hand of this page. A purely financial investor is often just going to look at the numbers that you have produced, at the profits that you're either generating or about to generate, and they're going to value those in black and white. A strategic, on the other hand, there's the possibility of synergies and the possibility of greater value. Again, your board and your advisors are going to help you identify how these players are, but I'll tell you what, leave aside the right-hand side of the page, the left is where the CEO focuses. Over time, do you see a fit between your business and somebody else in the space that you're actually working on?
Jim, let's just spend a second on this. In the context of aerospace, what are some instances where you think buyers, large aerospace companies, have been willing to pay a strategic number? They've been willing to pay more.
So, I'll give an example. I think that if you actually take a look at Northrop, who just acquired Orbital Sciences, which again is a later stage company, but it's one that you guys can all go online and read about. I think that is a strategic business for Northrop. I think if you look at where Orbital was trading, it was a standalone business that some people perceived as subscale, some people perceived it as having difficulty accessing capital to pursue the types of growth initiatives it had. But it was a real center of innovation and expertise. If you go back and you look at the aerospace industry and all the businesses and technologies that have come out of Orbital Sciences over the last 25 years, this has been a Bell Labs of the aerospace industry in a lot of ways. What Northrop looked at it is they saw that innovative capability, they saw their strength in certain core products, and they saw their ability as Northrop to actually advance their strategic objectives by owning the capabilities that Orbital brought to the table. And as a result, they paid a very, very large premium. They paid a larger premium than any financial investor ever could have because they have day one synergies. Certainly costs that can be eliminated because it costs money to be a public company. You need a layer of management and a layer of spending that you don't need as part of a larger public company. But really more than that is the strategic upside. And as we kind of begin to wind down, once you've figured out those buyers, once you have your advisors, you really need to be focused on running a clean process. This is as much for your own benefit and your own protection as a CEO and a fiduciary as it is for getting a good outcome. The last thing that you want to be as a CEO is known for selling your business through a quick and dirty process to one buyer who you've been talking to kind of behind the scenes, and you kind of engineer a sale instead of really getting the best deal for your shareholders. The best deal for your shareholders is going to come in a process that is organized, that is disciplined, where every buyer starts off with a level playing field and a good, clean start to the process. So that when the board decides to sell, that's the green light to go out and kind of engage with potential buyers and keep everybody in the same kind of pacing to the point where you bring all those dialogues to a head right at the same moment with final bids. And that's actually where you get to the point where you're going to get the best outcome for your shareholders. Two more points to make throughout the process. One, manage your board from beginning to end. This goes somewhat hand in glove with the previous point about running a clean process, but there's both formal and informal communications along the way. You have a formal series of board meetings where you consider bids that are coming in, you consider the materials you're going to use to pitch, you review the progress with the advisors, you review the progress with individual buyers. But there's also informal consultation, working the phones in the evenings to update individual board members on where you are. No surprises should be your motto throughout this process. No one board member should be surprised by the fact that a certain bidder dropped out. Generally, you're going to know if a bidder is going to drop out. Your advisor should be telling you that they're losing interest or they're running into issues, and you should be signaling that to your board as you go along. The worst possible outcome is you call that final board meeting and you think you're going to agree to sell the business to company A, and actually your board is unhappy with the way the process has been run, doesn't agree that you've gotten a fair valuation, and has no interest in selling the business at all anymore. So again, communication, both formal and informal throughout the entire process, leaning on your advisors to help you prep for that, and getting the message across clearly and in a concise fashion to your board members is essential.
Mm-hmm.
The last point that I'd make is that one of the common misperceptions that founders have is when I sell my business, I'm cashing a check and I'm riding off into the sunset. There's both formal reasons why that's not the case, and then there's practical reasons why that's not the case. Formally, it's very, very rare that the founder walks out the door the day the business is sold. You're either going to have a long-term multi-year contract to continue running this business and helping with integration, or you're going to have a transition agreement where you're on the job for 6 more months and you're actually being paid. And either you have an earn-out formulaically, or over time, you're going to actually realize additional upside in terms of financial proceeds to you personally by sticking with that process. Those are the contractual things. That's what you owe to the buyer from a legal point of view. What you owe to your team, and what I'd argue you owe to your investors and you owe to the buyer, is to run through the tape. You have to work closely with the buyer to understand exactly what their informal expectations are. You have to work with your team so that they understand that you're not walking away and leaving them as you go. You need to really be honest with yourself about the fact that this business is going to be associated with you personally long after the deal is closed. And the last thing that you want to have happen is for that buyer to come to regret the deal because you personally didn't get this done. Your reputation as a serial entrepreneur is going to be built on how successful your exits are. So the counterpoint to where we started the conversation, which is that good exits are really built slowly over time, is that good exits continue after the exit. And that you have a relationship and a real incentive to help that exit succeed and help the integration of the business continue long after you're no longer a formal employee.
Thank you, Jim. That was fantastic. We covered a tremendous amount of ground in an hour, and I think you gave us just the right level of overview. I'm not sure if we're in a position to take any questions. I know we have sort of a minute or two left here.
Yeah, so just one question we'll just, I'll start with here. So Jim, for yourself, you gave a lot of advice for people moving along the process, but for you personally, what catches your eye for somebody approaching you that makes you have the difference between like, yeah, I really want to work with this person and gets you excited versus not really? What gets you going?
It's the pitch, which is why we spend a lot of time talking about how important the pitch is. If a founder can't look you in the eye and explain very quickly why their product is special, why the market is large, why they're uniquely positioned in order to capitalize by bringing that product to that market, it's pretty obvious pretty quickly that they're going to have real challenges both raising capital and then exiting the business.
Great, thanks, Jim. And as you guys mentioned, we're right here at time. So with that, I'm going to pass it over to Gwen for just a few parting words.
Many thanks to you, Jim, and to Will. This was incredibly insightful and informative, and it is just the type of expertise that our innovators around the world need. So we thank you both very, very much. And to all of the innovators, congratulations on submitting your phase 1 submissions. As you all know, we will be awarding 10 prizes of $20,000 each on June 12th, and we will be beginning the phase 2 modeling and building phase of the competition shortly. So we wish you all the best of luck, and many thanks again to Jim and to Will.
Thank you.
Thank you.
Good luck, everybody.